right, for more perspective now on that Greece bailout story, I'm joined by Trevor Williams, Chief Economist, Lloyds Banks. Trevor, thank you so much for your time. Let's have it from you. Are you pleased with the developments of the last 24 hours? Are you in that camp of people who are saying this ain't enough?
The latter. You can see already that even 120.5% of GDP debt ratio by 2020, should the very optimistic economic assumptions turn out to be correct, is still intolerably high, with very little prospect of it being reduced significantly beyond 2020. So I think that it's very difficult to see how the second bailout will work. You already need a third bailout. You need to bring it down to at least 80% of GDP, which implies that there needs to be another significant package to get it down to that kind of level. And this comes down to the political will to enable that to happen.
So are you saying, Trevor, that the amount of the loan amount or the bailout amount should have far exceeded 130 billion euros? Or are you saying that the private sector should have taken a bigger haircut? Or are you saying that there should have been some other kind of ECB intervention? What is really missing from this package?
Well, what's effectively missing is a growth agenda, a way for Greece to be able to reduce the deficit through its ability to grow revenue, and therefore that is contingent upon the economy growing. And historically, the best way of reducing debt is to grow GDP, and there are very little plans in this that will show how GDP is going to recover.
Trevor,
if one looks at the nature of the Greek economy...
Trevor, forgive me for interrupting you, but I have to ask, what can the EU do to help Greece's GDP move up faster? I mean, isn't that something that Greek politicians and its citizens now have to put their heads to work on, and their hands to work as well?
Well, yeah. Well, I suppose I'm saying the same thing as that. There needs to be a number of things for growth to occur. One is that there has to be help from overseas. So there has to be inflows of foreign capital. There has to be help to support the Greek banking system. There has to be a willingness on the part of the Greeks to open their economy up, to be welcoming to foreign investment, to reform their labour markets, to reform their public sector, to reform their tax system, to become much more focused on generating greater economic activity in their economy in the way that the world economy now is. That means they have to become a bit like Ireland, for example, lower the basic corporation tax rate to very low levels, encourage foreign firms to locate in Greece, focus on the right education and skills, focus on the right type of infrastructure that firms like when they are locating in an economy. Greece can do that, but it will take a huge amount of political will. It will take a political consensus internally in order to do that, and that is simply not there at this time. You ask what the EU can do. Well, the EU can help that process by allowing Greece maybe to stay in the EU, but also, in my view, they may have to think seriously about whether or not they allow them to leave the single currency for a while and to let them have a competitive edge.
All right, so considering that a lot of the road ahead now depends on what Greece does, and the EU's played its part to the extent that it plays its part, I've got to ask you how some of the components of this package are going to work out. And I think of most interest is how the private sector is going to work through it. I understand the haircut's going to be about 53%. Is the private sector buying into this? Because I know that even in the first round, the PSI debt swap wasn't necessarily fully successful in any fashion.
I agreed, and I think that there will be huge implementation issues with this package as well. For a start, a lot of the plans that have been laid out in the bailout have to pass national parliaments, and I'm not sure that they all will, I'm afraid. Moreover, you quite rightly focus on the details of the PSI itself, and indeed whether or not this is any more voluntary default or whether it's and therefore not seen as a default scenario for swaps and swap insurance. At 53%, it seems to me to fall almost into the territory where if the members of the ISDA vote, they're going to vote that this is a default event, and therefore that will increase the costs associated with it. So I think there are huge implementation risks in the detail of this package. The IMF contributions, for example, and exactly how that's going to work isn't clear. What account is the money going to be placed in? Is it going to be an escrow account where the funds will have to be released by the donors to Greece in a drip manner with them overseeing it? There's so much which is still not clear about this package that it's difficult to argue that it's a definitive end to this crisis.
All right, let me give it a slightly positive spin. From the comments that I've been reading of all the press material, it seems the Luxembourg Prime Minister has said that the March 1st or 2nd EU summit will deliver a significant reinforcement of the euro area firewall. I imagine he's referring to the ESM. We're also expecting a second LTRO by the ECB at the end of this month or in March. Trevor, tell me, with both those events, if the firewall was significantly upped and if the second LTRO is as successful as the first in quelling debt market nerves, then do you believe that we've at least successfully put behind us the sort of the edge of the cliff kind of situation we were regarding Greece and managed to push the can down the road at least a few years?
Well, I think this is what the plan is, to push this disaster scenario further down the road. I mean, I think, look, first of all, we know that over the last couple of years this has been tried and it hasn't worked. But absolutely, the most successful action taken has been the long-term repurchase offers, which are 3 years, as you know, due to be announced again, a second round of it, on the 29th of February. I think that the firewall, i.e. the ability to be able to protect the banking sector and financial institutions from the negative effects of any default by Greece has strengthened enormously over the past year or so. Effectively over the last 6 months by the actions taken by the ECB, accepting all forms of collateral and lending off the back of it. But I'm afraid it's simply not the solution. What you're saying is that the firewall is to prevent this from spreading to other countries. It doesn't solve the situation for Greece. That remains the same. What it does do is prevent maybe some of the fallout from it from impacting other countries. But the jury is still out on that, in my view. The actual event itself will have ramifications. And there are other countries, I think, that could be affected by the fallout from this indirectly, like Portugal, for example, that has very similar problems to Greece about being able to grow, given the nature of their economy and given the size of the debts that they have.
All right, Trevor, it seems what you're telling me is there is no way out except for Greece to default?
I think it can be an orderly one. I think I'm more saying that there's no way out other than to leave the euro and get some competitive gains, spread the opportunity to be able to grow their way out of the crisis. And it's difficult to see how you can grow your way out of the crisis that they're in if they remain within the euro. They can, I think, though, perhaps with the help of other members of the euro, avoid a default if that's the will of their political partners. But let's not be too downbeat about the whole thing. I think that such an event would actually be good news looking forward. I think that this has brought some short-term breathing space, and I think the reaction of the financial market shows that this is so.
All right. In fact, the financial markets have turned down, even though they were initially cheered by the news coming in from Greece. A quick last question to you, Trevor, on the euro. Where do you see the currency headed over the next few months as the markets digest all the shortcomings of this second new package and prepare for a third?
Well, I think, look, the euro has strengthened, hasn't it, over the last couple of months or so. I think that what's remarkable is the way the euro is held up. The euro is behaving like a currency which sees that the fact of a default of an exit by Greece is good news, because it reduces the chance that the euro itself breaks up, because you're left with stronger members that can actually maintain membership. For me, that's the message from the single currency and its actions over the last few months against the US dollar. I think over the next few months, my view is that a recovery in the US, which will become more apparent, and the lack of growth in Europe will lead to the euro weakening as it needs to in order to gain more competitiveness in the context of a global economy that sees Europe as the laggard, with the US, i.e. North America, recovering strongly, Asia recovering quite strongly, and Europe being the one part of the world that is still caught in a slow growth environment.
All right, Trevor, we're going to have to leave it there, but appreciate you finding the time to speak with us today. That's Trevor Williams, Chief Economist at Lloyds Bank, weighing in on all the implications of that bailout deal that Greece just got, the second one. With that, we're entirely out of time on Your World at 10. Thanks very much for watching. Stay tuned to CNBC TV 18.